Billions in dirty crypto kept flowing through famous exchanges even after spectacular prosecutions and supposedly record-breaking fines. Governments announced victory over lawless platforms, yet scammers, cartels, and hackers quietly celebrated behind anonymous blockchain addresses. Some exchanges punished for laundering money somehow became even more popular with criminals immediately after their guilty pleas. So if regulators really cracked down, why did the world's biggest crypto platforms become crime's favorite, almost unstoppable cash machine? The story centers on global giants like Binance, OKX, HTX, Kraken, and Coinbase, running platforms from Dubai to New York. By the mid-2020s, these exchanges were moving trillions in digital assets yearly, outpacing many long-established stock markets. Investors, celebrities, and major sports teams lined up for sponsorships, turning platform logos into household brands on stadium screens. Marketing promised a fairer, faster financial future where anyone could move money instantly without traditional banks slowing things down. But behind the glossy ads, regulators began noticing disturbing patterns inside the rivers of transactions flowing through these platforms daily. Investigators kept finding the same exchanges in cases involving ransomware gangs, drug syndicates, human traffickers, and large-scale investment scams. Victims worldwide reported losing life savings to fake crypto sites whose stolen funds kept reappearing on big-name exchanges. Journalists and blockchain analysts quietly mapped suspicious wallet clusters, drawing a picture far darker than any cheerful commercial. And everything pointed back to one uncomfortable question. Were exchanges overwhelmed, negligent, or quietly choosing to look the other way? In an early turning point, one major exchange admitted breaking anti-money laundering rules and accepted years of external monitoring. Its billionaire founder stepped down, paid a massive personal fine, and promised the exchange would finally put safety above growth. Press conferences celebrated a new era of responsibility, while politicians cited the case as proof regulation was actually working. Yet months later, analysts noticed stablecoin wallets linked to notorious networks still pouring millions into that same reformed platform. Some transactions came from processors already flagged by international authorities as laundromats for online scams and trafficking operations. Even after official designations as primary money laundering concerns, those wallets continued moving funds into customer accounts for months. When experts asked why, company spokespeople insisted on television that blockchain design made blocking incoming payments practically impossible. They claimed suspicious customers were under review, but refused to reveal how many accounts were frozen, closed, or reported. Meanwhile, whistleblowers inside compliance teams described overflowing alert queues and pressure to close cases quickly instead of escalating them. One former analyst remembered spending hours on tiny microtransactions while multi-million-dollar flows received far less careful scrutiny. Another analyst said key customer information was often missing, making it impossible to know who controlled high-volume wallets. Still, trading volumes climbed, quarterly results impressed investors, and executives bragged the platform remained an industry leader in security. On another front, investigators quietly traced funds stolen by North Korean hackers from a huge international crypto exchange breach. The massive hack drained over $1 billion in tokens, later linked to missile programs and other prohibited weapons projects. The thieves rushed their haul through a token swapping service, repeatedly converting currencies to confuse anyone following the blockchain trail. But to finish the laundering cycle, someone still had to buy those tokens and send them into centralized exchanges. Blockchain analysts spotted enormous inflows from the swapping service into deposit addresses hosted at a very familiar regulated platform. Over 10 frantic days, hundreds of millions in suspicious tokens poured through those addresses like water through industrial pipes. Even basic screening systems, experts argued, should have flagged those flows and triggered urgent internal investigations and restrictions. Yet those deposit addresses stayed active, continuing to accept funds while the exchange repeated confident claims about real-time monitoring. As outside researchers published detailed graphs of the flows, the company declined specifics, emphasizing only its commitment to compliance. To observers, it felt like déjà vu: serious red flags, vague reassurances, and no clear explanation for the inaction. Things grew stranger when investigators examined organized crime networks running cash for crypto services for cartels and Russian gangs. These groups reportedly exchanged huge piles of digital tokens for hard currency, helping traffickers, ransomware crews, and corrupt officials. Authorities eventually dismantled 2 major rings and discovered they had used accounts at several recognizable mainstream exchanges for years. One launderer even kept an account at a United States-based platform proudly marketed as transparent and compliance-focused. Another relied on offshore exchanges, promoted by flashy influencers aligned with powerful political families loudly championing crypto adoption. A law enforcement source admitted the pattern was undeniable. Serious criminals favored the same handful of big, liquid platforms. And still, that was not the strangest discovery hiding inside the blockchain records and confidential government memos. As reporters dug deeper, they noticed something unsettling in politics, while investigators quietly compiled technical evidence in the background. After several high-profile enforcement actions, some regulators suddenly softened, dropping lawsuits against major exchanges they had previously criticized. A Justice Department unit dedicated to crypto crime was dissolved, with officials promising to chase criminals but spare compliant platforms. At the same time, industry leaders increased donations and partnerships, funding friendly politicians and launching patriotic, innovation-themed token campaigns. To many observers, it seemed the very companies under scrutiny were quietly helping rewrite the very rules overseeing them. That realization felt like a twist in a thriller, completely changing how experts interpreted years of failed crackdowns and warnings. Instead of blaming simple incompetence, many asked whether political donations and lobbying discouraged truly aggressive enforcement against profitable exchanges. Blockchain reports suggested these platforms process tens of trillions each year, earning huge fees on every transaction, suspicious or not. Official statements insisted most activity was legitimate, yet independent studies found criminals loved crypto because it stayed fast and global. Some experts argued exchanges faced nearly impossible technical challenges, overwhelmed by transaction volume and increasingly sophisticated laundering tools. Others suspected that if platforms truly wanted to, they could devote far more staff and budget to compliance. Critics warned that freezing funds or blocking suspicious deposits might shrink trading volume and anger the highest spending customers. Supporters countered that harsh restrictions would just drive innovation offshore, pushing criminals and regular users toward even darker platforms. Taken together, the evidence paints a murky landscape where every side claims progress, yet criminals choose the same convenient gateways. But whichever explanation seems closest, ordinary victims see their lives destroyed, while exchange profits rise and their cases stall. So the core mystery remains. Why do the same big platforms keep appearing at the center of so many scandals? Are these exchanges fundamentally overwhelmed institutions, drowning in data and clever adversaries, barely holding the line each chaotic trading day? Or are they highly profitable machines, quietly treating dirty money as just another revenue stream, shielded by politics and complexity? If you had to choose, which explanation feels more convincing to you, and which detail here disturbed you most?